Welcome to the Daily Drawdown, where today the AI boom meets financing, power, and market discipline. The biggest shift in AI right now isn't a new model release, it's the attempt to turn compute into a financeable asset class, and that pulls in banks, private credit, energy markets, and eventually the bond market. NVIDIA has lined up memoranda with Goldman, BlackRock, Blackstone, Brookfield, Apollo, and KKR to help customers secure up to $500 billion for AI infrastructure. Important caveat, that is a target under MOUs, not a committed capital pool. NVIDIA is acting as matchmaker, not balance sheet backstop. Why it matters is simple. This probably doesn't create demand from nothing, but it can make very large projects financeable for buyers that could not otherwise borrow tens of billions on their own. The pitch is that AI factories are long-lived, revenue-generating assets with resale value closer to power plants or aircraft than normal tech boxes. If that framing sticks, compute can be financed, securitized, and eventually sold into broader credit markets. That thesis is gaining traction because the bottleneck is no longer just chips. It's chips, data center shells, networking, land, power, packaging, and skilled labor all at once. The scale numbers are enormous. Larry Fink put 1 gigawatt of data center capacity at roughly $50 billion to $60 billion. Morgan Stanley has talked about roughly $3.5 trillion of hyperscaler spending across 2026 through 2028. Annual CapEx estimates keep getting revised higher. The finance angle depends on fungibility. If one customer fails, another operator can often step into that compute stack and keep the asset productive. That makes lenders much more willing to underwrite it. The catch is that AI build-out is really an energy and industrial build-out. Panels flagged shortages across power, construction capacity, photonics, copper, and labor. That points directly to higher demand for natural gas, LNG, copper, and grid equipment. For investors, the second-order beneficiaries may sit as much in industrial supply chains as in software. There are also macro risks here. Oil around $80 is manageable. A sustained move into the mid-90s or above gets much more disruptive, especially with refining constraints and Europe's winter gas exposure. And the U.S. Strategic Petroleum Reserve has fallen below 300 million barrels, a level not seen since the early 1980s. That matters because it reduces policy buffer if energy markets tighten into a major infrastructure build. On the spending side, the message from analysts is still early innings. Some now see hyperscaler CapEx growth reaccelerating above 50% in 2027, which is much more aggressive than earlier expectations. But investors are no longer rewarding spend for its own sake. The market wants proof that CapEx becomes revenue and cash flow, not just bigger clusters and louder headlines. That helps explain the rotation. Leadership has shifted towards semis and infrastructure, with NVIDIA breaking out again, while some large software and consumer names like Google and Apple are seeing more skepticism. As inference spreads out, the winner list may also widen into optical, networking, and fiber names, because bandwidth and optical capacity are harder to scale quickly than many people assumed. Meta is pushing hard on open source and on-device AI, including releasing Muse Glimmer Weights designed to run on a consumer laptop. The strategic case is lower cost, broader access, and less dependence on giant centralized closed models. That could shift economics toward cloud and orchestration providers like Microsoft and AWS, which can monetize open models through hosting and tooling, even if model margins compress. At the same time, AI is accelerating cyber risk. Researchers reportedly used OpenAI and Anthropic models to reverse engineer an Apple patch and produce a working exploit for unpatched Macs in about 4 hours. Cloudflare says autonomous agent traffic has already surpassed human internet traffic. That changes the attack surface fast, and it means security has to move toward explicit permissions, runtime monitoring, zero-trust design, and machine-speed defensive systems. The next constraint is financing quality. Private markets can absorb a lot before public bond markets do, but opacity becomes a real issue when assets stay marked at par while underlying economics weaken. Cross-ownership and circular financing are the bigger concern. In a rising rate world, long-dated infrastructure with uncertain ROI becomes much harder to carry. Watch the 10-year Treasury here. Multiple commentators treated yields above roughly 4.5% to 5% as the danger zone for an indefinite AI financing strategy. That's why Fed uncertainty matters. Kevin Warsh has stressed the 2% inflation target, but markets still do not have a clean read on how he would balance rates and the Fed balance sheet. Softer jobs data bought some breathing room, but CPI, PPI, and long-end yields are still the key near-term tests. Outside AI, the broader bull case is still earnings-led. Depending on the adjustment, reported growth has been very strong, with wide sector participation, cleaner hedge fund positioning, strong buybacks, and AI capex feeding through multiple industries. The main threat to that bullish setup is the same one showing up everywhere else: higher long-term rates driven by deficits, bond supply, and the capital intensity of the AI build itself. A few names to watch. Apple is facing valuation pressure as analysts question whether delayed or canceled premium hardware features can still justify a roughly 33 times forward earnings multiple, especially if AI features do not drive enough hardware upgrades. Berkshire under Greg Abel is showing somewhat more willingness to deploy capital, with equity purchases and buybacks cutting into the cash pile, but skeptics still want to see whether that becomes true high-conviction capital allocation. In semis, TSMC's July sales were up about 45% year over year, and the company still expects full-year growth above 40%, which keeps the hardware demand signal very strong. Intel's capital raise shows the other side of the story. Expansion is expensive, cash flow can lag badly, and financing conditions matter. And on the speculative edge, some investors are now pitching SpaceX as a future hyperscale compute player. The revenue math being discussed is huge, but for now, those numbers are aspirational and depend on both product success and continued compute scarcity. Two quick non-AI items. The FDA has proposed requiring companies to notify the agency when they self-determine an ingredient is generally recognized as safe, which would close a long-standing transparency gap without imposing blanket pre-market approval. And Take-Two says Grand Theft Auto 6 pre-orders are exceptionally strong, especially at premium price points, but management is already warning that early demand does not automatically translate into the kind of long-tail performance investors remember from GTA 5. That's the setup right now. AI demand still looks real, but the decisive variables are financing quality, power availability, and the path of long-term rates. You're listening to the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.
Podkey.